The topic for this panel is a little broad, but that gave us the opportunity to come up with a lot of really random and interesting things to talk about. But since it's only 20 minutes, we're not even going to get to half of them. So I want to just get into it. This has been kind of a weird year for tech startups. It's been the busiest year of the decade for IPOs, and there have been some really good ones like Pinterest and Zoom. But for some of the biggest offerings, it's actually been very bad. Uber, Lyft, and Peloton. I'm curious what this means for you all as private investors and for the market at large. You have thoughts, Jason?
Yeah, I mean, there's always cycles, right? You're going to see up and down, and right now there's a lot of money in the market. And so anytime there's money, you're going to see driving up of valuations, which is exactly what you've seen. And you're going to see some of those that don't work out because there's a lot of hype behind them, and some of that you saw with WeWork, right? You saw a lot of hype driving up something that they didn't really understand what the true value creation. So I think the challenge becomes, there's a lot of money chasing it, don't get caught in the fear of missing out syndrome, right? And really work at saying, can we take a look at this company and see where are the real value drivers behind it? And even if it's not making a lot of revenue or money today, where can it go? Is there a true addressable market that it's focusing on?
Yeah. Carmen?
And for us, we invest very early stage, so pre-seed and seed. And what we're seeing is companies just taking longer even to advance to the Series A level. That's about 4 years before they even get to Series A. So for us, as early stage investors, we're thinking about exits differently. We're thinking about potential secondary markets, and the opportunities there are increasing.
A story many of us have been fixated on recently is one that you mentioned, WeWork. This was a company that went from $47 billion valuation less than a year ago to something like $8 billion a week ago. It's got mounting debt without its longtime CEO, facing mass layoffs. What lessons can we take from this bizarre meltdown?
Sure. Well, we passed on the opportunity a couple of years ago, so we're not close to the company and can only comment at a very high level.
That sounds smart in hindsight.
But without diminishing the value of co-working spaces in general, I'd say that WeWork strikes me as an example of a company that over-leveraged venture and other funding sources to create a highly dysfunctional capital structure. So even though we're seeing some promising and new real estate models emerge to accommodate a broader range of evolving distribution use cases that have opened up with increasing channel proliferation, and we're seeing many of these companies, in fact, surpass growth expectations for their category. I've always maintained that it's important to respect certain laws of funding physics. So things like exit caps and modest multiples and price erosion, particularly in the face of growing competition, can and do massively constrain the realm of possible outcomes. So in the case of WeWork, it was a situation where the public markets ultimately disagree with private company valuations, and I would expect for companies to be valued in increasingly consistent fashion, particularly as we see tech companies experience multiple compression in the public markets.
I don't think it's the last time you're going to see it. I mean, if you've read Malcolm Gladwell's new books, Talking to Strangers, he has something in there called truth default theory.
Right.
And it's the idea that if we want something to believe, we want to believe in something, there has to be enough mounting evidence against it before we will talk against it. So everybody wants to believe that in tech and real estate, commercial real estate's a huge total addressable market. We think it's $1 trillion market. That's sexy, right? And there was enough, Adam did a good enough job selling this company and believing that it was more than a real estate play, right? And so people kept piling on, and because it was private, nobody really knew exactly what they were doing. So the first amount of evidence that really pushed us over was when we got to see what's coming out in the S1. And that's when people said, hey, there's enough evidence to say this isn't a true tech play. This is more of a real estate arbitrage play. And that's when the valuation fall off. But this happens in tech all the time.
Right.
We want to believe something's true, so we get behind it.
Right.
Valuations climb, and that's why it's even more important for the good houses, good investors like these ladies, to say, hey, what's the true value, and is there going to be a real company at the end of the day that somebody wants to stand behind?
Yeah. WeWork is probably a bit of an extreme case of startup freakouts. Let's talk about something with broader impact. How is the trade war with China impacting companies you follow or work with? Has that played in with into the early stage at all of any companies, like where they choose who to work with or where to manufacture?
Yeah, we invest in tech you can touch. So we have deep expertise in manufacturing and supply chain, and the trade tensions have been disruptive on many different fronts. One of our portfolio companies called me a few months ago and said, are these tariffs real? Like, are they really going to go through? And it seems like we keep balking and punting the ball. And so, fact of the matter is, it's just disruptive for a startup that's beginning to develop their supply chain and enter into commitments on where to manufacture. There are other options, though, now for startups. We're seeing potential manufacturing opportunities in Poland and Africa. So there are alternatives, but at the end of the day, if you follow the money, a lot of those manufacturers are being funded by Chinese investors.
It would be awkward to talk about politics without acknowledging that one of the guys on the stage works for one of the most powerful conservative political donors in America, Jason. You've talked with us about this before, and we've written a bit about it recently. But I think the people in this room might be curious to know what it's like to work for a family that Jon Stewart once described as robber barons bending the democratic process to its will since 1980.
Interesting question you pose. Here's the deal: I'm new to Koch Industries in the last couple of years. It's a privately held company that we have 130,000 employees in 60 countries, and there's one of the questions that often comes up is this exact question. And I think that Koch Industries in general, we've done a poor job of telling our story. For the most part, we're not nearly as political as people think. We are principled entrepreneurs. We don't vote red or blue. And all the entrepreneurs that we talk about, the first things they ask us is, how was Koch built? And Koch was built on the entrepreneurial spirit, right? And that's really what we try to take as in talking to any of our startups or investments and how we grow our company. There's a difference between being private and being secret, and we're private. And I think in a lot of ways that benefits our company, and I think a lot of great privately held companies can innovate wildly because they don't have to worry about what the market says about them on a quarter-by-quarter basis. And so at the end of the day, what's it like to work for the Koch family? It's actually wonderful because at the end of the day, they believe in free markets, they believe in entrepreneurship, and they believe in making what's best for society, and they free their people up to do that. And so it's been a great opportunity for myself, but I think that most of the people I talk to have the same experience.
All right. We've got a poll for this session. What if you guys could pull out your apps and jump in? The poll for this one is, what's the greatest threat to a healthy startup ecosystem? So some of the options laid out for you: overheated valuations, a global economic slowdown, prolonged trade wars, a weak IPO market, or overregulation. And there are probably a million other factors that could play into this, but I'd love to hear what you guys think about it. And do our panelists have any thoughts on what could bring this all to a halt?
I can start. I think immigration is a big issue. In terms of the startup ecosystem, many other countries have a startup visa. In the US, we do not. It's very easy if you're starting a company to go to somewhere like Canada and get a startup visa in a matter of weeks. And so that is a big deal. It's causing entrepreneurs to go abroad and start companies. If they've studied here, if they've gotten their PhD here, why not go back to their country of origin and start a new company with seed capital from government entities? So I think that's an issue that we need to respond to.
Speak a little bit about overheated valuations. Overheated valuations and the general supply of opportunistic capital that's available to startups these days present a pretty interesting dynamic for the market in the sense that it creates dislocations in value that makes the capturing of alpha much more challenging than it used to, in the sense that companies are taking longer to go public, and so certain segments of investors can no longer bank on making their money vis-a-vis an IPO, but that presents new and interesting opportunities for later stage investors to potentially consider either funding companies through alternative sources that go beyond equity. Beyond that, the extent of private capital available certainly creates different incentives for companies in terms of the way that they manage their balance sheets. Some instances it can create a culture that may substitute cash for creativity and operational discipline in some cases. But it presents a different framework for how to think about capturing alpha in that market dynamic.
If you would have asked somebody 15 years ago that, hey, you're going to get in a stranger's car and they're going to take you somewhere, you would have thought these people are insane, right? Or if you're going to rent out your room of your house, like
staying in some stranger's bedroom.
Yeah, you're going to stay in a stranger's bedroom. You're like, no, I'm not. That's crazy. But that's Uber and Airbnb, right?
Yes.
And the reason those things work is because we free great entrepreneurs up to do it. When we start regulating everything that we ask them to do, we're sucking the creativity out of our own ecosystem. We're sending it other places. Other countries are willing to do it, right? We can't over-regulate these companies. That's what makes America great, is people from all shapes and sizes and cultures can work together.
Right.
And they can be free to try new ideas that just become part of our culture. And as soon as we start regulating that, we won't be as great as we once were.
I won't read too much into the fact that that's a basic conservative platform. That
you can read into it as much as you want. I'm good with that.
Okay, so we've got a bunch of votes in, and the crowd agrees with you, Jason, over regulation.
They're voting with us. They must be conservative.
Yeah, looks like people are voting against it now. The numbers are changing a little bit.
Touche.
So another issue that doesn't really play into this, but has resonance politically, both ends of the political spectrum appear to be disillusioned by the power of big tech companies. Let's say Trump's DOJ or President Warren do go ahead and break up Amazon, Google, and Facebook. What does that mean for startups and the rest of the tech ecosystem? Antitrust, what do you guys think?
I think it's bad. Once again, it's the regulatory thing. It's like, at the end of the day, yes, I believe that there is a level that we need to make sure that we have. Consumers need to control their own future and their own data and be able to have a sense of freedom. But when you start going in there and making decisions about what companies you can break up and which ones you can't, that's a slippery slope that starts going all over the place. And okay, you can get Facebook but not Google. You can get Google but not Microsoft. Like, where do you draw that line? And who's smart enough in this room or anywhere else to draw that line?
Well, not to mention that it can be very difficult to break up companies or to unwind complicated mergers. These represent very heavy lifts for antitrust in general. So it can be very difficult to be in a room to figure out what portion of a business makes sense to spin off with a broken entity. And in some instances, when you consider the network effects of some of these companies, it can be challenging to unwind a merger as a means of spurring innovation when a new monopoly could just re-emerge from that network effect. So it's challenging to begin with, but I agree that it's about striking the right balance between creating a conducive environment to promote competition, but at the same time, you want to be sure that you're not over-regulating to a point where you're thwarting the potential benefits of a competitive framework.
Right. I mean, that's the argument in favor of it, is that it would foster more competition and smaller companies could compete. You think there's any merit to that, Carmen?
I don't think so. I think startups consistently look for the white space and the gaps, and so I don't, at least at the pre-seed and seed stage, I don't think that it causes a big issue.
Okay. Let's talk about workplace diversity. It was designated as a priority by the industry maybe like 6 or 7 years ago. Now we get these corporate diversity reports that serve as this like annual embarrassment for the industry because nothing seems to change and the numbers are always so bad. How do we fix this? Carmen, you're working on a couple initiatives.
Yeah, I think there's power in community. So I'm involved in many different groups and on several different platforms. One of those platforms is called VC Include, and that brings together diverse managers and women that are investing in early stage tech companies, puts them in front of investors, family offices, sovereign wealth funds, and that's the type of access to capital that we need to increase the numbers. So right now, about 4% of assets in venture capital are managed by women. About 4% are managed by minorities. So that's a small amount, but I think that platforms like VC Include, organizations like All Raise, Latinx VC, Black X VC are creating communities where we can then share deal flow, and that's exactly how Silicon Valley started. So I think there's a tipping point and we're at an inflection point where we're going to start to see more diversity in the ecosystem.
Yeah, I think the key word that she used there is community, right? I mean, we need to start that education process early with kids, right? We need diversity not only in nationalities and colors, but in intellectual thought. And that starts early on how we train our kids in schools and where they play and who they hang out with. And if you start there, then it becomes natural as you grow up. If you try to all of a sudden say, you've operated one way your whole life and all of a sudden we're going to make you change that because we have to have something else different, people are fighting to adapt to that. And so once again, this comes back to if we free people up early on and we teach our kids to grow up in that diverse community, then we have more diverse communities and businesses long term. And I think to your point, I think you're starting to see that because I think we've done a better job in the past, but it takes some time to come to the surface. So it's taking some time to see the results.
What does a global economic slowdown or recession do to startup investing? VCs are sitting on massive piles of cash. Are there any immediate effects, or does it play out over a longer period of time than it does in the stock markets? Recession? A
recession, yeah. Well, I think the impact will first be felt within the public markets because tech stocks tend to be high beta and tend to swing a little bit more on a more volatile basis. But generally, I would expect to see more of a trickle-down effect in terms of how private valuations are impacted, and would expect for companies in the private sphere to be similarly impacted. But beyond that, for early stage investing, as the cost of capital starts to increase, would expect that to impact how companies start to think about managing their capitalization strategies, which will likely involve more discipline in terms of how they think about raising capital.
I think we're just about running out of time, but thank you guys for coming out and for listening.